10 Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. During this outlook for 2026, we'll be addressing key questions that may be top of mind as we head toward the new year. I'm Suzanne Silverman, Editorial Director of Multi-Housing News, and our expert panel today includes Jamie Woodwell, Senior Vice President of Commercial and Multifamily Policy and Strategic Industry Engagement at the Mortgage Bankers Association, Sharon Wilson Géno, President of the National Multifamily Housing Council, Alex Valente, Principal at Trammell Crow Company, Tyler Griffin, President of Mortgage Banking at Lument, and Mike Miner, Head of Investment Sales at Berkadia. We're recording this session and it'll be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. Don't be shy. And thank you to those of you who submitted some in advance. We'll try to get to as many as we can. First, though, Jamie, could you please set the stage for our discussion?
Yeah, you bet, Suzanne. Thanks for having us all, and particularly me. Really looking forward to the conversation today. If you've got the slides, just wanted to run through a couple of points to set up the discussion, which I know panelists will have a lot more detail on as we get into it. But really wanted to just talk through three elements of what's going on in multifamily markets. One, what's going on with supply and demand dynamics. Two, what's going on in the equity markets, and three, what's going on in the debt markets. And those three together, I think, give us a good foundation for the conversation we're going to be having. If we start off on just the supply-demand dynamics, we're at this really interesting point in terms of where we are in the balance there. We've been coming off of a place where we've seen more multifamily construction than we have at any time really since the mid-70s. And at one point, we had 1 million multifamily units under construction in the last couple of years, which tops what we saw in the 70s. So just a really strong set of supply coming into the market. We're still seeing pretty strong permitting and starts. They're down significantly from where they were a year or so ago, but still at a pretty decent level if you look historically. Similarly, the completions are also starting to come down from a peak of what we saw just a couple of months ago. They were as high as the starts were as high as about 600,000. We're now at about 400,000 or so. All of that new supply is having an impact on the market. So we've seen vacancy rates that were at about 6.5% back in 2021 and 2022, now topping about 8.5% based on census numbers. That new supply is starting to slow, but should continue to come a bit. The rise in the vacancy rates, the softness in the market has then followed through to rents. And if you look, what you see is that in-place rents, folks renewing the rents, still some good, healthy rent growth there. But new tenants, when someone new moves into a unit, we're seeing really flat to potentially down rents in those places. That's having an impact on effective rent growth as well. And just seeing the market again, after a period where we were seeing growth of 10% in terms of effective rent growth back in 2021, now seeing it just slightly on the positive side. Moving on to what we're seeing in the equity market. So what are investors seeing in this market? Similarly, it's a really interesting point of transition. If you look at where we've come over the last 3 years since prices peaked in 2022. Multifamily values by many indicators are down about 20%. So that matches what you see in office writ large. If you look at office, though, and CBD office, it's down about 50%. So no real comparison there between what's going on in multifamily and what's going on in office. And the other important thing to note on multifamily is that 20% drop in values is after we saw a doubling in values between 2016 and 2022. So the market saw that robust growth that's now some of it has been given back some. With that uncertainty in some of the values, we have seen sales transactions lower. They're up a bit this year, about 5% compared to about 13% for all property types, but still at a relatively subdued level. And that lack of transactions means that when you're looking at price indicators like this and other things, you have to read them with many filters on, because just without that transaction volume, you don't really know what's happening there. And I think another key point for the property fundamentals, as well as what we're seeing in transaction and other volume values, is that it's really property by property, market by market, that the individual characteristics matter more than they probably have in a whole long time. Turning to the debt markets a little bit and what we're seeing there. On the debt side, we've seen transaction volumes increasing, but have still been at a relatively muted level. If you look at multifamily originations in 2025, year to date, we're up about 44%. From where we were for the first 3 quarters of 2024. The third quarter itself was up about 27% this year's Q3 versus last year's Q3. If you look across the market, really every capital source on the debt markets is looking to put money out. If you look across all property types, not just multifamily, you have banks and other depositories lending up about 74% this year. Private credit's up about 67%. The GSEs 41%. Life companies 35%. There's just been a real appetite to put money out, and particularly in multifamily. That competitive market means that we're probably going to get to about 23 or 230 billion or so of originations next year, maybe upwards of that. And that's on the fact that we've got more than $300 billion of loans set to mature. So an awful lot of loan maturities, some of which will be extended, some of which will turn into refis or sales transactions. So a very competitive debt market there. And then just to the last piece, interest rates, always an important topic for us. This is a picture of the Fed's dot plot. The Fed just met in December and came out with their decision to cut the Fed funds rate one more time for 3 in a row by a quarter point. What the dots here show is what members of the Fed think where the Fed funds rate will be at the end of 2025, 26, 27 to 28. And when we talk about the Fed planning to do X or Y on rates, I just always love looking at this to remember that the Fed is not one entity, but rather a whole group of people with very different opinions of where their future might go. So just looking at where they expect 2026 to be, you've got essentially a 200 basis point spread in where they were thinking they would end 2026 just as of this last meeting. And that's, of course, a whole separate conversation than what's going on in the longer term markets. So, Suzanne, that's a quick dump of a lot of information, but hopefully that helps set the stage.
Thank you very much, Jamie. Yes, that gives us a good basis for our discussion. So let's get into the panel's perspectives on what's to come. And let's start with a broader question. And Sharon, maybe you could start us off and share with us the signals you're watching most closely to gauge where the multifamily market is headed next year.
Sure. Well, as Jamie pointed out, there's a lot going on, and it's really interesting. As Jamie's charts indicate, certainly starts and completions are big headline indicators. But I look at 2 other things too that I think are really interesting. One, confidentiality agreements, which a lot of the brokers will report out, which will give you some sense of the health of the market, regardless of where interest rates come or go. If people are out there signing confidentiality agreements and they're going to try to make some kind of investment, that is, I think, a good indicator of sentiment. And then the other one I look at are absorption rates. And even though, as the charts point out, we've had these over the last, now we've had 10 plus quarters of dramatically reduced construction starts, they're starting to tick up again. We still have this hole from 2+ years ago where starts were so far down, and even to keep up with the supply curve we already have in a normal year, we're already going to be way behind. So even, and then we have historic deliveries from projects that were delayed during COVID and really coming up till 2021 when the interest rates environment changed. So if you look at absorption rates in multifamily, even with some concessions and other things, they're relatively consistent with historic norms. So that tells you household formation is continuing to happen. People are out there in the market, certainly with perhaps a lower effective rent rate because of concessions, but the demand is not going away. And what that tells us is because of this dramatically reduced start period over the last 2.5 years, even though it's starting to go up now, we're going to be back where we start coming out of COVID with a pretty significant shortage situation as long as those absorption rate numbers stay where they have been.
Anybody have any other signals to add?
I like the point on absorption, just because of the underlying resilience of demand, and I think it's something to keep an eye on. Obviously, the strength of the job market has been also very, very resilient. We did get numbers today. It's very timely. Unemployment went from 4.4 to 4.6%, so a little bit of softening there. But I think that's something to really keep an eye on because that's going to be part of that equation to keep absorption strong as we work through the tail end of that big supply wave.
That's true, Mike. And I think we'll get into some more regional discussions later. But when you look at job markets across the different areas, and you talk about, Sharon's talking about the units that were put into some markets where we had oversupply, like your Austins and Charlottes, the strong economies and jobs that are still being created is still in Charlotte, right? You're still in Phoenix. You look at those job creation numbers. Some weaker ones are like Atlanta and Portland, where we also did see additional units, but there's definitely two different kind of markets getting created out there between the economies and the job creations.
Good point. Good to keep an eye on the more local level. Alex, how do you see macroeconomic factors impacting multifamily performance in 2026?
Sure. Thanks, Suzanne, and thanks for having me on here. Nice to see everyone. And I should say, by the way, to kind of start it off, that I focus on Southern California, kind of multifamily ground up development, but we got offices all across the U.S. And just in general, I'd say for macroeconomic factors, I think as a company we think they're supportive for development in 26 and multifamily performance. Falling rates, they've come down and came down again last week. Feels like moderating inflation, which is I think a good thing. Most people would agree with that. And a little bit less uncertainty, I think, will kind of help with things like household formation. I think we're actually sort of seeing on our end, absorption has been a little kind of slow across the U.S. We haven't seen the household formation across the country and here in SoCal that we would like or would be super supportive for development. But just in general, from a macroeconomic perspective, I think we think sort of it's a positive tailwind for 26.
Okay, thank you. And Mike, are you seeing signs of stabilization in rent growth and occupancy, or do you think 2026 will bring more volatility there?
Yeah, after 2025, it's hard to ever predict stability. While I can't necessarily pinpoint where it will come from, I think you always have to be ready for a little bit of volatility. But Jamie kind of hit on this when he gave a nice overview of the supply wave. I think volatility that's related to higher supply will lighten this year, but it's going to take a little bit of time. As I look across the country, I see a couple of themes that will hold true towards the beginning of the year. The first is, if speaking in broad terms, we're still seeing softness in rents, and that has creeped over into occupancy. So Jamie gave the vacancy numbers that they have ticked up. Concessions continue to take place in lease ups, and we have seen that in new leases as well in pockets. If you look at lease renewals, have been more stable, lack of concessions, and you see those flat to up in a lot of pockets. The only other thing I would say is there are some bright spots across the country. Specifically, the Midwest region is experiencing stronger fundamentals. They haven't had to ride the same supply wave. So I was actually on the phone yesterday with some of our brokers out of the Midwest, and they were reporting increases in rents from 3 to 5%. So I'll specifically mention Chicago, Columbus, Milwaukee, Kansas City as some of the stronger performers. The only other thing I might mention when it comes to stability as we look at rent and occupancy, the next kind of time period I'm keeping an eye on and circling is the spring leasing season. Right now, during the cold months, not a lot of people want to move, not a lot of lease movement. It's relatively stale, and we actually see a little bit of a step back during this time. But what does it look like when spring arrives, the sun comes out, that spring leasing season? I think that'll be a pretty good indication of the health and the stability of those occupancy and rent numbers. Again, it's not the end all be all, but it's the next kind of check-in time period for us to see what it looks like and what stability looks like.
That's a good point to look ahead to that spring leasing season since we're in the depths of winter at the moment. Anybody have anything to add, or shall we move into talking about investment? Okay, well, Jamie touched on interest rates already, but Alex, can you talk a little more about what you've seen as the impact of the recent interest rate cuts?
Sure, happy to. Can't wait for spring leasing, by the way, Mike. Um, um, you
Spring
know,
anything.
recent interest rate cuts, I think they're good. They were, expected, especially this last one. There's been it's tough to be too excited about it. I mean, there's been 6 cuts over the last year and a half. Meanwhile, 10 years actually gone up 50 bips in the same amount of time. So that kind of long edge of the curve is kind of getting still kind of pointing upwards. So I think it's good from the perspective of consumer sentiment, which I think will translate into more household formation, kind of better leasing. I think multifamily, this is an MHN Voices seminar podcast, seems to be kind of the most sensitive to interest rates. And I think I think this combined with the fact that all this kind of new supply kind of burning off, which is going to be kind of more and more apparent here in 26 and 27, will be good for kind of valuations and for new development, which is what we focus on here at Trammell Crow Company.
Yeah, Alex, you're talking about the longer end of the curve. It's a consistent thing that we focus on the debt side as well. We keep seeing the 10-year creep up, and the reality is we're not going to get relief on that until we get some relief on the deficit. I don't want to get too far ahead of ourselves talking about policy and stuff. I know Sharon is pretty in depth there, but that's really our biggest concern is if we can't start controlling the bigger macro items, deficit, trade issues, are we going to really ever get any relief on the 10-year? And I don't know if the answer is yes in the near term. So, but the front end of the curve going down has been great. It means you can go back and do some CapEx. You can get maybe some rehab going again. You can see some acquisitions where there's upside, and that's all very important to get our industry back up and moving more quickly.
Agree. We're treating that higher for longer 10-year as a sort of fixture for the next few years. It's definitely changed our expectations in terms of like required yields for development and stuff that we can actually kind of get capitalized here, at least actually in SoCal and really across the country.
Right. Makes sense.
Good points. And Mike, what's your expectation for the pace and the volume of investment next year?
So at a high level, or maybe the headline answer is I expect investment to increase year over year. This year we expected investment sales growth, but in total we're only seeing single digit growth, so that 5 to 6%. That said, our investment sales pipeline at Berkadia right now is at historic highs across deals on market and in escrow. It's actually about 35% higher than the same time last year. So you have kind of this tension between sales intentions and deals getting done. Obviously, that's kind of the challenges we see in the market from the financials, the bid-ask gap, what sellers will do or can do, and what I would describe as buyer discipline. If I look out to this year, I kind of see it playing out in 2 chapters. So in chapter 1, the sales velocity looks essentially the same as what we're experiencing in 2025, right? Again, still working through that bid-ask gap, Are there a lot of market sellers who will sell? Most of the deals getting done today were loan maturities, equity wanting out, developers or sponsors that might be out of their promote and wanting to reset their business opportunities. But if you kind of look at chapter two, and I don't know when chapter two arrives, but I do anticipate at some point in 2026, might be more in the second half than the first half, but fundamentals are going to start improving due to the supply story kind of turning a corner. NOI will increase, and we're going to see deal velocity increase at that point. And I think once we turn that corner, I think it takes actually a step up in sales velocity. I don't think it's necessary linear. I think there's a lot of, again, pent-up demand for both sales and capital that is ready to put that to work. But we need kind of those clean financials, that clean T3, the clean T6 to kind of be a little bit of an unlock. Only other thing I would say, just from an investment strategy perspective, core plus and light value add has been very much attractive this year, and I anticipate that to continue to happen. Core deals will be a priority of just needing to sell. And then we've seen more distressed sales within our pipeline start to kind of trickle through in a heavier amount than in years past. I know people have been wondering and waiting and asking that question, and I anticipate that will take a step up in 2026. Just those deals that need to kind of get worked through the system being brought to market, and we're starting to see that trickle up more and more.
Okay, anybody have anything to add to that? Any other perspectives?
We're seeing the same thing on the distress.
Okay.
So hopefully that'll start clearing out of the market. I know that's what everyone's been waiting for.
Yeah. So Jamie, let's talk a little more about public policies, housing incentives, zoning reform, rent regulation, whatever else you might add. What public policies are most shaping new investment decisions looking into the new year, or maybe should shape those new investment decisions?
Yeah, you bet. And Tyler already hit on the rates, and that's one we could probably talk all day about. And then I'd love to get Sharon's thoughts as well. I think about the fact that the public policy has just an incredibly profound impact on the investment decisions, and it's been very much on display this year. And if you look at the federal level, you can look at the Tax Cuts and Jobs Act. A lot of those provisions were set to expire. That we had a very positive bill come out of that, which maintained tax rates, and particularly for pass-through entities. No change to 1031 exchanges, an expansion of opportunity zones, expansion of low-income housing tax credit. Lots of very positive elements that, if they had gone the other way, would have really stifled a fair amount of activity. You then have the direct government programs, things like HUD rental assistance, which has been threatened by some of the proposals, but so far has preserved FHA financing, where we've had really dramatic improvements to the program throughout the year, including reduction in the mortgage insurance premiums. All of those are good positives. There are then government rules and regulations that impact things like the Davis-Bacon requirements. That's a place where we're continue to chip away at it. That's at the federal level. Probably even more impactful is the state and local level, which is a constant battle. You've got the incentives on the one hand, you've got disincentives on the other hand. Things like local subsidies or building bonuses, tax abatements, and other things generally promoting, but then zoning restrictions, rent regulations, mandates around eviction and others on the negative. And then just quickly before turning back over is, both Alex and Mike mentioned certainty and uncertainty as just a key. And so when you see some of the changes being proposed in local governments, or not even proposed but enacted, that can have a really chilling effect if they're on the negative side for development and investments.
I'll add a
Sharon?
couple perspectives. First of all, the fact that we're even having federal housing policy being marked up today and passed is monumental. we have the attention of lawmakers on both sides of the aisle. Housing is becoming into the next year where we're going to have midterm elections, the quintessential purple issue for lawmakers who might have gotten their seat by a vote of 51-49 in their district or 48-52. So we have this golden moment. The legislation that's being marked up today is really nipping around the edges of a lot of technical changes, frankly, with a handful of exceptions, but it opens the door for more federal attention on this issue. There's a whole series of lawmakers who did not get their bills in this package who are going to be back out there in January with new bills. So stay tuned. There's a lot of action. This is, in many ways, the moment we've all been waiting for, but it has some potential risks as well. The second piece of this that I'll mention, and Jamie, you touched on too, is the states are starting to follow suit. So there's increasingly all this action at the state level, much of it around technology. So it used to be that we were really focused on bread and butter, real estate related issues. Now you have the administration putting out executive order, effectively preempting AI laws in various states, which have a huge impact on multifamily real estate. You have the Federal Trade Commission making statements, public statements around how we use technology to convey fees and talk about that. So there, and then you have states and localities following behind them, passing laws around the technology side. It really is a huge potential impact on investment, because if multifamily housing is an asset class that has greater limitations on the kinds of data it can collect in the future, and other asset classes don't have those same limitations, we're going to become more of a disfavored asset class, especially in the new AI world. So we really have to watch, watch all of these things, not just our traditional real estate things, but also some of these technology, AI related policies as well at the federal level, and then three-dimensional chess at the state and local level as well.
Just a reminder to our audience to please submit questions if you've got them through that Q&A feature. We'll be turning to Q&A in about 15 minutes or so. And let's fit the GSEs into this as well. Tyler, what's the status and what are your expectations for the impact on 2026 of what, however much happens with them?
Yeah, always a loaded question these days. And Jamie mentioned FHA, which has been positive. The GSEs are also on a positive trajectory right now. Just recently, they announced higher caps, $88 billion each. For those of you tracking along at home, the caps this year were $73 billion each, and the agencies are expected to hit those this year, or at least come very close, both Fannie and Freddie. $88 billion is a huge increase, really. It's 20%. There is some concern, in the industry, but it's twofold. Can we as an industry hit those caps? Do we have the correct staffing? Does Fannie and Freddie have enough staffing to execute on that much more business in the coming year? And then is the market going to be there, right? Pace of acquisitions and that kind of thing. But in general, that's all positive. Now, you can move into even further into kind of the policy and politics of it of, well, are we going to privatize the GSEs this year or next year? For those of you who remember the first Trump administration with Mark Calabria being head of FHFA, there was a lot of uncertainty around what was going to happen with the GSEs. Mr. Calabria is still back. He's not head of FHFA right now. That's Pulte, as we all follow along on X. But the Calabria idea of possibly privatizing this is still there, and Calabria is still in the administration. The difference today is that there has been a real kind of circulation back around the mantra of do no harm. And that's what's most important here. Maintain liquidity and do no harm. In 2016, it wasn't clear if that was going to be the goal if we did privatization then. Today, we're pretty confident as we talk to the players and the agencies and at FHFA that any privatization, any IPO that happens with the agencies is going to be done in a way that maintains liquidity, doesn't cause a lot of disruption, and keeps people. Remember, we're multifamily, right? We're this much of a much larger piece of this puzzle. So it keeps people moving forward on the home buying process. That's one of the largest parts of our economy. Construction of homes, renovation of homes, buying and selling of homes, and all the different things that go with it. We don't want to disrupt that. And it's been good news to hear that kind of the people involved that get to make those decisions, that's their trajectory right now too. So all in all pretty positive. And hopefully we'll get some more staffing and ideally though mostly the acquisitions from Mike pushing us forward and increasing the overall production. But I'll keep watching Mike and see what he's able to do.
All right, Mike, the pressure is on.
Challenge accepted.
And Suzanne, just building on what Tyler was saying, I think
Mhm.
echoing exactly that the administration is out there. They're looking for input. They've held meetings. Both FHFA and Treasury have held meetings to get input from the industry. They're talking about do no harm. They're listening and they're talking about some of the things that have to happen to make sure that there is no harm, such as making sure there's a government guarantee on the MBS, making sure that there are two or more, so you've got competition in the GSE market, a bright line between primary and secondary market, and a strong regulator and capital and other things. So we're really pretty optimistic about that. The one other point, again, magnifying what Tyler mentioned, when you're hearing the news about it, there can be action in terms of selling part of the government stake in the GSEs that can be completely distinct from their current operations. And the director of FHFA has said explicitly, we can look into selling a stake, but continue to operate them in a safe, sound manner with maybe
Right.
nothing even changing in the day-to-day operations.
Okay, well, let's move into incorporate more debt talk into this from there. And Jamie, if you could talk a little bit about how the players in the capital stack are changing and how that's impacting the market. Start with that.
Yeah, sure. And would love to get Mike and Tyler as well. But I think from
Definitely.
our perspective, what we see is we see that capital stack getting ever finer divisions within it, that people are just looking to be able to focus on the particular risk reward elements that they want. So it's not just a market where you've got a slice of equity and a slice of debt. And then within each of those, you've got a large number of players focusing on the debt side. You certainly have the GSEs tend to be 40-ish% of the market in any given year. But then banks, insurance companies, private credit, CMBS, and other investors, each with a slightly different sweet spot there. And so just an incredible set of options for borrowers to go low LTV, higher LTV, et cetera. And then on the equity side, that's a place where I think you are seeing. I think of it as the debt side is the debt side, and you know where rates are, and you know where you go from there. But the equity side, where you really need to figure out what are the prospects for an individual building, therefore, where's an investor want to be, and what's the nut on that to solve for. But lots of capital out there looking to invest in the multifamily market right now.
Yeah, I mean, we even saw some equity players who in the past we would expect to be putting out new development money right now, moving over to the debt side because they didn't like their options. I mean, in my opinion, that's kind of a loss for all of us. We need the equity. But you can go to Charlotte right now. There's very little equity for new development in Charlotte. But as we mentioned before, that's one of the places where there's still positive job growth. It's a good area to be in. The problem is that supply is not going to dissipate until probably 2028. So people aren't willing to be the next one in the ground.
Yeah, Tyler, spot on. I was going to make a similar observation, right? Follow the money. Those equity providers moving into more of private credit, which
Right.
obviously we have a lot more debt liquidity right now, but finding equity partners is challenging and goes back to some of the tensions we're seeing between sales intentions and deals getting done. As they move back to being willing to put that capital to work in an equity position, it's going to be one of the just green shoots to track on for increased sales velocity.
So that's something to watch out for. Do you see more of a shift back into the equity side earlier in 2026? Is that likely to be later on?
I would say I use the example before of two chapters. It's going to be part of two chapters. Having a lot more equity available is getting deals done. Even when we see on our bid list, some of the sponsors showing up if they don't have necessarily the equity in place right now to go out and fundraise. It has been a little bit more challenging, but we have seen some of our development raises get more people to the table than they have in the past. And some of the recaps that we have been shopping across the network have also been a little bit more favorable than they were 6 to 12 months ago. So I would say slowly trending in the right direction, but that'll be part of the unlock for increased sales velocity.
Okay, and actually, Tyler and Mike, we could get the lender and investor sides of how both are adjusting their underwriting standards or expectations to hopefully start to move a little bit.
Yeah, underwriting standards changed on the back of 2023. Kind of right the valley of this part of the cycle, at least from us, from the debt perspective. A lot more due diligence these days, a lot stronger requirements around borrowers. I see Alex smiling. It's been painful, right?
I think it's probably right size. So no complaint here on the debt side. I think we like how the credit markets have opened up, especially for kind of construction loans right now in our business. So
yes, but the underwriting standards. I mean, there's been a focus back to quality, which is important. But in general, it's still going back to markets, right? Like if we're doing a lot in the Austins right now, probably not as much. There's not as much opportunity there. Lower Midwest, like Mike mentioned, we're seeing a lot of positive changes in the assets and in the credit quality of the sponsors. So that's all good news. But the underwriting standards, they kind of are what they are. It's just a matter of how much extra due diligence and work are we doing around them.
Yeah, on the investor side, I describe it as a lot of investor or buyer discipline out there. They're holding their ground on pricing on most opportunities so that the market will come to them. In 21, 22, a little bit less disciplined in that regard, just because the market was moving so quickly. But I think at this point in the market, they're able to be more disciplined. It's really hard in a lot of markets to underwrite rent growth in year one. And the farther you push out that rent growth in your underwriting, the harder it is to hit your returns. So that's why we really need to start to see that the rent growth, the occupancy improve a little bit. Once we get some cleaner financials that investors can underwrite to, we'll see them lean in more than they have to this point. I will say it is worth noting there has been a bit of a dichotomy. So for the right deals, so quality product, Core Plus has been very popular, stronger market, sub-market. We have seen movement in the bidding process. So where bids came in on their initial offer to best and final offers moved anywhere from 4 to 7% on average. And that is capital wanting to be deployed if they can kind of get their head wrapped around the opportunity. And again, probably a good supply story in there, probably a good barriers to entry on that sub-market, some strong fundamentals. But we have seen some of those deals outperform when they have kind of the right characteristics.
And another bright spot, we are seeing a change in duration, right? So through 2023 up until recently, 6 months ago, most loan requests were coming in 5-year float or maybe a 7-year deal. Now we're starting to get back to some longer term 10-year loans, which means that we're seeing stability. Investors are seeing stability, not only with the asset performance, but with interest rates. And kind of the idea of, well, maybe I'll wait and see if rates go back down is going away. And I think that's a good thing because it means the bid-ask spread's going to come back in based on today's rates. And we're not going to keep having this argument between buyers and sellers of whether or not they're going to get a lower rate environment and they can do better. So we see that as a positive sign.
Alex, can you touch on what you anticipate happening with new construction next year? Excuse me. I know we've been talking a lot about overhang, but of course, Trammell Crow is a development business. What are your anticipations?
I think we're going to see a pretty sharp drop in construction starts the next 2 years. We got pretty much everyone's got pretty good visibility into it. It's super difficult right now to kind of capitalize on the equity side. These new developments feels like it's pretty well covered in the news media, but it's very tough to get new starts going, especially when folks on the investment side can kind of buy below replacement cost, which we're definitely kind of seeing out here in the West Coast. I think from a capitalization standpoint, which will kind of lead into more new construction in the future, you will start to see more deals getting capitalized. It's going to be pretty apparent here that supply has been absorbed. It's been a little bit slower than we all thought it would over 2025, but I think when you kind of get into 26, 27, we're all kind of just seeing this cliff of supply. You're going to see vacancy rates go down. I mean, we're still kind of in this 5% range here in SoCal. We've got like a fundamental imbalance here in housing and population, but I think there'll be way more pressure and will to put all that capital and equity that's on the sidelines back into development starting in 26, 27, but you're still not going to see that product, kind of get delivered for, 2 to 3 years, but you're going to have a pretty visible decline here in deliveries over the next 2 years.
Okay, anybody else have anything to add on that? Okay, well, you've set the stage for us. And before we switch to Q&A, Tyler, you've mentioned some specific geographic differences. Mike, you mentioned the Midwest, but let's go just a little bit more into the most notable geographic or demographic shifts that are influencing demand characteristics.
Yeah, sure. It's everything always comes back, right? This pendulum swings all the way over here during COVID, and people run away from all the cities, and all of a sudden the Sun Belt's bursting at the seams, and now the pendulum has swung back. But when you're an investor, you're always chasing that. So the investors were down in Alabama and North Carolina buying because the cap rates were better than they were in New York and Chicago and everything, and it made a lot of sense. Now, as that cycle continued, those cap rates continued to compress because everyone was crowding around the same markets, and then we got oversupply that we keep talking about. So today, where are renters going and where are the investors moving behind them? Well, yes, it's the lower Midwest, but it's also the coastal markets again, right? So, and we have a producer in Birmingham, and I spoke to him the other day. He said, I was so busy for a while, and now I feel like everyone else is busy, and I'm looking around and we're not doing much. I said, well, that's because you can buy in Chicago at a 5.5 cap, and all the guys in Alabama still want a 5.5 cap. Like that doesn't work. So right now you're seeing the Chicago's, New York's, and even I'm sure, Alex, you're seeing on the coast in California, the demand is back for those properties, and the rents are there too. They seem to be relatively occupied.
We're starting to see transaction volume pick up here in SoCal. I think it's partly because everyone can kind of see that there's going to be kind of no new product delivered here the next 2 years. So I think you start to get a little bit more comfortable in these sort of kind of high barrier to supply markets.
Right.
Okay, well, let's turn now to some questions from the audience because we do have quite a few. And if anybody's got more, please go ahead and add them in the question feature. This person says they were reading an article about the Housing for the 21st Century Act, the bipartisan bill introduced by the House. They're looking for insights on that and its potential impact.
I'm happy to take a swing at that. That's the bill I was mentioning earlier. That's really a conglomeration of things that were in the Senate's quote road to home bill, which was a conglomeration of something that pretty much everybody on both sides of the aisle on the Senate Banking Committee had wanted, various small pieces, and also some reforms to the home and CDBG programs to make them more housing friendly. And home and CDBG are formula grant programs that go to states and localities that can be used for a variety of things. home or housing related, but to really focus it on the thing that we need the most, which is housing production. So it's a lot of small, I'll call largely technical changes. The one thing from multifamily owners that has been something of an ongoing confusion in various states and localities is it will include something called the Respect State Housing Laws Act, which will clarify that the 30-day notice provision that was included in the CARES Act is no longer applicable. This was creating confusion at the local level. And frankly, in the last administration, they had taken a position that on Fannie and Freddie deals that provision still applied, even though the COVID emergency had long since gone. Some people perceived it as a drafting error. Some people perceived it as just a political will. But that puts a little bit more predictability back into the whole lease termination process. And that too helps investors. So a lot of small changes that could have some impact. What I'm really hopeful is this is an important first step to getting even bigger changes. So this is a good start, and I'm glad we're getting through it.
Yeah, and I'll just add that what you've got is you've got from the House side, you've got the Housing for the 21st Century Act, from the Senate side, the Road to Housing Act, and the Venn diagram is got a lot of overlap there, but there are some pieces that differ a bit, and so getting them all together. But what building on what Sharon mentioned, what's almost as exciting about the individual elements about it are that you've got House Republican, Democrat, Senate Republican, Democrat, all pushing this housing agenda forward. So it's really a great sign.
Hey, we've got an interesting question here about what impact AI will have on wages and projections of homeownership rates and household growth by tenure for 2025 to 35.
Are you going to call on someone for that, Suzanne?
Sounds like a
Anybody
Jamie
who
question.
wants to take it? Jamie.
I was going to say, that feels like a Jamie question.
Given that I don't know which ChatGPT, which one to go into. I think the really exciting thing about AI right now is that it's got this potential to have really significant positive impacts in a lot of different ways. And what's equally mind-numbing is that we just don't know at this point. I mean, I think when we talk to our members, they're putting AI to work right now as very scalable junior analysts, and that there's a lot that can be accomplished there, but there's also a lot that needs to be supervised and looked over and triple checked. And so I think the amount of investment that's going into AI right now is certainly a sign of people voting with their pocketbooks that there's going to be significant impacts from it going forward. I'll say that, and then I'll caveat that internally around the water cooler here, we've got a range of opinions about the degree to which it's really going to change our own day-to-day lives. So I don't think that really gets to answer the question, but hopefully I skirted around it enough to.
So we all try to figure out how it impacts our businesses.
Absolutely.
Anybody have any further thoughts?
It's tough to figure out how it would apply to our business specifically. I do see a lot of uses for it in the management business. Maybe a lot of tasks could be automated and really get some economies of scale there. That's probably, in my opinion, where it's going to head first.
We're seeing, we manage, we don't manage, we third party contract with, managers like Greystars of the world across, our 15,000 units across the country. Definitely starting to see a little bit of kind of reducing of like operating budgets with respect to like assistant managers and like sort of back of house things that folks are definitely dipping their toe into, like taking that and sort of aggregating that cost potentially kind of across properties, even with different owners, with AI things. So it's definitely starting to kind of make its way into our business, and then it's currently made its way into like the San Francisco real estate business, where we're seeing some nice recoveries there.
Okay, we've got another question asking us to break things down a little bit by class of property, given the economy and the unemployment data. Do you see upward or downward movement for tenants in Class A versus B versus C?
I mean, I can start there. There's a pretty clear downward movement in the B minus C product. We have seen some direct impact of the new kind of stance on immigration and deportation, frankly. So in those, depending on the market, now you're back to Texas areas, Phoenix, Arizona, and even into the Carolinas a little bit is where you're seeing a shift. But then the A properties, again, it depends on the market. If you are in the Austins and Nashville, you're getting a lot of downward pressure on A properties. If you're in Columbus, Ohio, in that lower Midwest that Mike was talking about, you're getting upward pressure on those properties because a lot of those tenants that were priced out of Austins and Nashvilles are doing quite well now in Columbus. So that's kind of what we're seeing there.
I'll add another just segment of the market is affordable capital A. Keep in mind the tax bill doubled in size the low-income housing tax credit nationally over the next 10 years. That's the incentive program that allows builders to build housing for folks at or below 50 or 60% of the area median income. Double the incentive. So that is a lot of pressure on that system. Certainly, it can be a complicated program, and you have to know what you're doing in order to operate it. But I can see some fairly decent growth in that sector fairly quickly as state housing finance agencies figure out how to get that resource out the door faster and really empower developers who sometimes had to wait 2 or 3 rounds to get that resource to build much faster.
The other thing I would just add on the interplay between A, B, and C class is I've described it as operators playing defense in 2025, meaning trying to hold on to tenants, avoid kind of the switching, keep occupancy a little bit higher. And in order to do that, you've seen rents come in a little bit. You see concessions on the lease up and whatnot. We've also seen income increase higher than rent has increased. So cost of rent compared to income is actually a little bit more favorable right now for renter base. So what that has led to is A's trying to hold on to it, and maybe people in B able to move up, or C move up to B. All of that leads to a little bit of a downward impact on this, B and then eventually the C property, where they have felt some of the impact of the higher supply, maybe even a little bit more than those Class A and Class B, especially from a occupancy perspective.
We've got another new question. Should refinancing in 2026 be with a long fixed period or just floating rate off the start?
Tyler.
It depends on, obviously depends on your view. It also depends on your business plan. If you need to sell or you're interested in doing a value add in the short term, you probably want to take something more floating rate just to be able to get out of it easier. But if your project is stable, if it works for you today, we always say, take it if it works. Because if it makes sense, you don't want to regret missing it.
Okay, and once longer term rates drop, what prevents overbuilt markets like Austin from getting overbuilt again? That sounds like a tough cyclical question to me.
Occupancy.
Or absorption rates. I mean, just keep your eye on those absorption rates.
Yeah.
That's a pretty good bellwether.
I think overbuilt to me sounds like a good word. I mean, like it just means it's good for the consumer, it's good for the renter, it's generally good for communities to get more affordable housing for everybody. It generally kind of hurts folks like us when things get overbuilt with too much supply. It kind of hurts our ability to go into that market, but in general, for the actual community, I would view it as a good thing. So hopefully that'll happen. That means capital's kind of going back into Austin.
Mm-hmm. Sharon, any particular advice for how the industry can better collaborate across investors, developers, and policymakers to meet housing needs?
Yeah, well, I think we have one great example, and Yardi has been instrumental in getting this off the ground. we developed in partnership with the mortgage bankers, the National Realtors Association, the home builders, and our partners at the National Apartment Association, something called the Housing Solutions Coalition about a year and a half ago. And Yardi was first money in to help launch that effort, which is an effort which we're so grateful, but it's an effort for all 5 of these large organizations to ignite their networks in various states and localities to promote with the same message and the same data housing solutions that do work, and most importantly, push back on solutions that are being elevated now that we know don't work, like rent regulation and other things. So it's an education effort, it's an advocacy effort, and it's a way for all of us to connect with each other as advocacy groups and as players in the industry. So we're all singing off the same song sheet, and lawmakers at the state and local level in particular hear the same message from everyone at the same time. So we're still looking for more investment in that effort. Let me know if you're interested, but Yardi's commitment has been huge here, and we see more things for this in 26, particularly as we're going to see a ballot question in Massachusetts this year. We're seeing rent control continue to come up in locality after locality after locality. If you're pushing back on this in your community, the Wall Street Journal, after a lot of work and effort, did a great article yesterday comparing the results in St. Paul and Minneapolis over the last couple of years. St. Paul instituting a rent regulation regime, Minneapolis choosing the opposite. So the numbers are in, and they really prove the point. So if you're interested in that, certainly that article is a really good microcosm of how we can work together with the same data and move policy forward.
Thanks. It's good to see more collaboration, and obviously it makes a difference. So thank you for leading that charge. We just have a couple more minutes left, so why don't I just go around and ask everybody, and Jamie, maybe we'll start with you. What gives you the most optimism, and what keeps you up at night about the multifamily outlook for next year?
Sure. And maybe I'll reverse them. And in terms of staying up all night, I don't think anything, fortunately. We've got an incredibly strong and resilient market, as we're seeing right now, the system, the different players in place, it all works. And it's just great to see the way it does. In terms of the optimism, I think it's the foundational need that there is for multifamily housing, right? Through thick and thin, there's going to be need for multifamily, and that helps us power through times, and means that there's always going to be good things going on in the market.
Okay, who's next? Mike, can you go next?
Yeah, I'll start where Jamie finished off. We're in the multifamily industry. It's such a durable market. There's always going to be long-term needs. We have proper liquidity in it, and it's very attractive. So that is always going to be a source of optimism in this space. I also think the debt markets, which was a headwind, if you look back, a year or two, is moved more into a tailwind. As I look forward to this year, can we see a similar story with supply? What has been a headwind move to a little bit more of a neutral position and become a tailwind. That bid-ask gap that I mentioned, can we actually kind of tighten that up and get to some really good deal flow? Very hopeful and optimistic we'll see that at some point this year down the road. And then the only other kind of question mark I have is the unknown unknown, right? What is that? What's the volatility that lies ahead that we might have to navigate? Don't lose sleep over that because it's unknown, but it's always hanging out there.
Mhm. All right, Tyler.
Sure, but you guys are too positive, so I'm gonna give two concerns.
All right.
Number one
ahead.
is, Jamie mentioned a stat. He said values doubled from 2016 to 2022, I think it was. I'm embarrassed. I didn't know that. But affordability really concerns me. And Alex mentioned overbuilt's a good thing. We've got to build more. If people aren't doing construction starts and we don't have enough equity, these are concerning to me because we've got to do more to create housing. And then my second concern for not necessarily this year, but longer, is still that deficit and where our long-term rates headed, because we're fine in the 4% range, 4 to 4.25, really. If we start getting back up over 5% on the 10-year and anything that moves quickly, it could really stop us and really halt our momentum. So that's always kind of in the back of my mind.
Thank you. Alex?
Sure. So optimism, I was thinking about this. At least locally, CEQA reform. It's kind of the big word out here in California, but it's been pretty meaningful this year. With AB 130, essentially kind of exempts infill development, under 85 feet, which is kind of most of the housing that we provide. That's a really good thing for producing more supply long term for our business, especially here on the West Coast. This sort of supply cliff, and I'll kind of bridge this into what keeps me up at night. But the supply cliff is real. It's coming. It's actually going to help in the short term, folks like us, like developers, get projects capitalized. I think you really are going to see a fair amount of rent growth here in SoCal, in California, probably across the country, frankly, as all of this product gets absorbed. But what keeps me up at night is kind of what happens when these rents inevitably start going back up and you start hearing kind of more and more chants for rent control. It just sort of feels like this pendulum. I think, Tyler, you mentioned that earlier, is going to happen. Rents are flat right now, or at least they're flat in SoCal. They're down in lots of kind of the parts of the country with high supply. But all of a sudden, these rents start going up and no one can figure out why, and they kind of get mad. And then they start banging the drum for rent control. So we'll see where that goes. Supply is a good thing.
Okay, and then Sharon, if you could finish us up.
Again, echoing much of what has already been said. One, we have agreement on what the problem is, and it's supply, and that is agreement that the common person recognizes, not just politicians. So when you have agreement on a problem and you have attention of government on that problem, like we do right now, for better or for worse, in this whole affordability conversation, there is real opportunity for real long-lasting solutions, and that's what gives me optimism. Thing that worries me is that because we have the agreement on the problem, and because we have all this attention, that we will be politicized by one side or the other, and we will continue to be used as something of a football rather than making sure that people on both sides of the aisle look at housing not as a political issue, but as a human issue. And how do we get everybody moving in the right direction on this, and not to use us for political, perhaps well-meaning, perhaps not well-meaning, but solutions that are not effective long-term.
Okay, well, unfortunately, we are out of time. We're actually a few minutes past time. So to everyone in the audience, we will be sending you a link when the recording's available, and we will be posting it on our website as well. And if you enjoyed this webinar, please do keep an eye out for our communications on next year's webinars. But for now, thank you again to all of you speakers today for a very interesting discussion. Thanks to our audience for attending, and I'll see you next year.
Great, thank you.
Thanks.
Bye.